Good morning, traders. It's 8 a.m. Chicago time, 9 a.m. Eastern. Thanks for joining me again today on another Trader Bite. Derivatives trading involves substantial risk of loss and is not suitable for all investors. Past performance is not necessarily indicative of future results. The overall market stance is it's all red this morning. Everything is red. So the only thing that's up today is the dollar. The dollar is trading at 97.1, up half a percent or so. Um, the rest is down with gold dragging the lowest. It's down $22.30. Remember, gold was highest yesterday behind the DAX. Gold is down 1.74%. Europe took a bit of a hit today, down more than 1% on the Euro stocks, 1.32, and the DAX is down 1.38%. And then we see that the S&P 500 is down 14 points this morning, or 0.59%, currently trading at 24.20, well below yesterday's range low. Okay, so that's where we stand. Crude oil is at 44.53, also dipping. It sold off yesterday. As far as the news events, the key thing, of course, is the fallout of the FOMC. The FOMC did what the market expected, where the market really responded, is that it's the Fed has laid out its plan to unwind its just ginormous $4.5 trillion balance sheet. It says that the Fed will reinvest the principal of maturities only if it gets back more than $6 billion in principal returned in a given month. The cap will then be increased by 6 billion every 3 months until it reaches 30 billion a month. So it's really soaking that up. The market is not pricing in any further rate hikes into the end of the year. The probability of a rate hike in September, 16.7% currently. And the probability of any rate hikes at all is down to 40.2%. Most of you probably already know the Bank of England met and it held the interest rates. What was interesting about that is that the Bank of England's vote was 5-3 to leave interest rates unchanged. So there are three members there that believe that rates should change. The vote was unanimous for the asset purchase target. It's unchanged at 435 billion. We also got the June Empire manufacturing this morning at 19.8 versus 5.0 expected. And then at 7:30, we also got the U.S. May import price index at negative 0.3, worse than negative 0.1 expected. Year on year, 2.1 versus 2.9. Initial claims came out fairly strong, 237 versus 241,000. And then Philly Fed also came out strong at 27.6 versus 24.9. Looking at what the market has coming in today, we get industrial production and cap utilization here in 11 minutes, right when the trader bite ends. At 10 o'clock, we get NAHB housing market index. All times are Eastern U.S. time. So 10 o'clock NAHB housing market index for June expecting 70.0. 10:30 we get EIA natural gas expecting 91. And then after the close we get some minor numbers, the tick flows. As far as speakers, not seeing any key speakers today. After the close at 4 o'clock, we get BOE speaker Carney. Okay, so that's where we are today. Let's take a look at what we expected yesterday versus what we got. Here we go. So yesterday, the expectation is for responsive selling. Expected the market to drop. All week I've been talking about the fact that we're likely to, not the fact, it's not a fact, the probability, the high probability that we would push to 44, 24, 43 and a quarter and make new all-time highs. And that's what we set up last week and how we ended up closing on Monday uh, uh, gives a pretty strong clue that the auction is likely done to the downside. If it's done to the downside, it's likely to go and seek sellers, and so it's likely to rise. Yesterday, the main early draft is downward, so we're looking for responsive selling. I expected it to find a base at 38, 24, 38 area for a bounce up. And then it's likely to trade outside of range until the FOMC, at which point it's likely to take out the all-time high. This did not work. Okay, so early on we had some pretty good indications there. I was looking for support, went down to the point of control, and then it just could not. It could not. We had some pretty clear. Uh, there was no investment or loss or stop necessary to be taken on Hypo One because we saw immediately that there was um, uh, drive-like behavior in price. We didn't see it in the delta, but it's we can't rely on a delta currently because of the rollover and expiration tomorrow. But it was clear that the sellers were in control. The secondary hypothesis is to leave the gap open to 39 and a quarter, leave the gap zone open, eventually get down and test it. And then from there, it's the FOMC. This was also off. The hypothesis that actually worked out, which I didn't post here, is hypothesis number 4. um, the third hypothesis was a drop that I drew out was a drop into the point of control, holding here and then popping strong on the FOMC. So dipping down into the prior day's range, consolidating for a bit, and then popping back up. Hypo 4 was a drop into the prior range, into the point of control, holding steady, and then testing the gap that we had left the day before and potentially pushing down into 24, 22.75 before stabilizing and finishing somewhere in the middle. That was Hypo 4. Again, that's in hindsight, of course. Here's what actually happened. It did not dip as far down on Hypo 4 as I planned. Um, but overall, you could see that there was a pretty quick drop on the open, a pullback into the prior day's high, which was also the mid, and then a drift down into the point of control, the prior day, pushes through by a few ticks, consolidates, finds its base. A clear setup for me here. Um, a clear setup for me here at the mid for a rotation for a potential continuation into that prior point of control, and then we end up pushing higher because of the FOMC. We pushed higher early. The FOMC high is 24.4075. That's recorded right here in your flex levels, 24.4075. Notice the FOMC low is the NFP low, the most recent non-farm payrolls low by 2 ticks. Same lows we put in on non-farm payrolls before buyers stepped in and formed what is a clear channel back to balance. So what have we done yesterday? We've basically built a profile that shows um, a pretty orderly move down, pretty orderly exploration or discovery down through the prior day's low. But then overall, look at the point of control. The point of control is higher. So we ended up yesterday with a higher high on the open. We ended up with a lower low post FOMC. FOMC is at 1 o'clock Chicago time, so it's in here, right here somewhere. Um, but value, overall value, ended up right on where the low volume node. We moved the point of control higher. We're holding steady. This morning we ended up selling off. We ended up selling off to where we are now, which is not expected. I expected the overnight session to be sideways with a slight upward drift. I expected um, this channel that was built into the close to continue higher, which did not happen. Okay, so that's where we stand. Looking at the overnight session, here we go. Just sellers right from the get-go. Sellers right there. Sellers on the European Open. Sellers a little bit later in the session in the European Open, and unable to find its bottom. The profile overnight has tremendous volume. It's just outside of one standard deviation of overnight volume. Again, that is influenced by rollover and expiration tomorrow. So there's some numbers in there. It's probably double where it normally is. If we half that, it's about where we would normally expect it at 140,000 or so. But overall, you can see it's a trending profile. Multiple distributions, pretty effective price discovery, one-time framing type of trading. And then what we have here is an impulsive move that is now consolidating, and it looks like it wants to shape up for a lower low. The overnight high is right up here at 35.50, which is against the MC, the new MC point of control. The MC point of control has shifted up. So what we're doing right now is we're trading beneath the MC point of control, and we are in that target, the hypo 4 target at 2275. We're in that area. So as I shift this profile forward, you'll see that there's the MC point of control, the black line shifting up right there, right on the close. And now it's at 35.50, and we're trading below. So this morning, expect an open auction out of range. Expect responsive buying into the open as the main ingredient of today. I'm expecting this to really continue to squeeze higher. Uh, uh, I'm expecting this to continue to squeeze higher. Most of the move overnight is based on geopolitical or mostly political news. The expectation is we're likely to continue higher. That's my hypo 1. The main drift is upwards. I'm expecting it to be responsive, meaning going back to its most recent balance or wherever the most recent spot the market found value, that's where we're likely to go. So that's hypo 1. We're looking for it to be responsive. Hypo 2, if it does test higher and then pushes down, I do expect it to find a base somewhere in this area. We have some pretty good rejection down here. So I'm expecting it to hold. And again, I'm looking for responsive but weaker. And then it might hold these prices down here instead of moving towards 35.50. The key target for hypo 1 is 35.50. For hypo 2, because of the exploration downwards, I expect that it would have expended some of its energy and it's not able to push and hold deep into the prior day's range or prior days range and value. Hypo 3 is an early attempt at responsive, unable to hold, and then we start to drift down into, and the key test area becomes this high volume node down here at 2411. We're at 2412, but if we do get down to 2411, don't don't start rubbing your hands together expecting some magical sell-off to happen. The market behavior is as soon as we make new lows, we start to put in a corrective formation and start to move back up into the point of control or the mid or the VWAP of that day, sometimes even neutral. So that's what I'm looking for on hypo 3. Okay. For those of you who are maybe new and don't understand how these hypos, this all seems theoretical. It's not. This is consider this as you sitting through the briefing for what's going to happen in today's battle in this war, right? And the goal is to lay out the plans, but as traders, we're like soldiers. We respond to what's actually there. We don't just assume that just because we didn't expect, enemy is the wrong term to use with the market. It pits us against the market. We're not. We want to be in alignment with the market and use its force. But just because you assume the enemy's not going to be behind some door doesn't mean that you just walk in casually. As traders, our job is to just create the plans, and usually I have 5 of them. Create the plans, wait for the market to tell you which one is likely to be in control, and then trade from that side. Okay, then you engage and execute from that side using fibs, moving averages, whatever it is you want to use. Doesn't really matter. As long as it works for you, that's great. Then push from that side. Okay. So these are the hypos. This is the purpose of the hypos. This is not all theory. This is real trading. Take care, and I'll catch you tomorrow. Take care.